We're now going to have the last session before lunch. It's a general discussion about capital markets and equity investments. Our moderator, Sally Ann Underhill, co-office managing partner here in Athens with Reed Smith. And on the session, we have Stavros Gyftakis, Chief Financial Officer of Seanergy Maritime Holdings, Evangelos Chatzis, if he's still here with us, yeah. Evangelos Chatzis, Chief Financial Officer of Danaos Corporation, Simos Pariaros, Chief Administrative Officer with Euroseas and EuroDry. Yep. And Hugh Eden, who's Managing Director of Jefferies. Sally Ann, please.
Thanks very much, Kevin. So we've got a great panel today, and I know it's just before lunch, but please do try to keep listening. As we were walking over the road, somebody from my office said to me that this is a topic that was raised last year when we were all here. So a year on, we still seem to be in a position where vessel earnings are great, vessel values are really high. So what we're going to be thinking about is how long that can last and what it means for raising capital and equity, and get some views from this great selection of panelists. So turning to you first, Evangelos, it's suggested in the question that we've got a couple of years still for this to last. So my question to you is, what are your views on how long we can expect this favourable market to last?
Well, I can speak for container ships, which is our main line of business. We've obviously been through a very good 3-4 years ever since COVID broke out. And although I have to admit we were all expecting some sort of plateau or even some sort of weakening, in 24 we had this whole situation with the Houthis and all this, which again kept the market very strong. I'm not the one to tell you that this is going to last for 1 or 2 more years. What I can tell you for us is that we are able, going through this prolonged good period, to fix ships for periods of 3 to 5 years, which means that effectively, come what may, no matter what the spot market does, we're going to be insulated. So we have a very clear path. We have very high charter cover percentages. We are now, like for next year, close to 90% contracted, and for the year after that, north of 80%. Pretty boring, actually. But it provides very good visibility. And the problem is that with all the cash that is being generated through the good earnings, it's not that easy to invest it because there aren't that many obviously good opportunities out there. As you said, everyone is making money, at least most sectors. Valuations are pretty high. There's no real distress in the system that would sort of provide opportunities. And if you're public, unless you're following a very, let's say, distribution-friendly shareholder policy, you're not valued anywhere near NAV. And if you're on the one side, your underlying business is really strong and you're earning very good money, and on the other hand, you're valued at 50 cents to the dollar on your share price, I don't think raising equity capital makes any sense whatsoever. So whether capital markets are there or not is one thing. Whether it makes sense for certain companies to raise equity capital, it's a totally different thing.
Yeah, so I think it was Clarkson's the other day that was saying that out of all of the different vessel types, containers and LPG carriers are doing the best, and they're leaving other tankers and dry bulk slightly behind them. So, Simos, turning to you, do you have anything to add to that in respect of, obviously, container ships, and you deal with both, container ships doing so very well? What are your views on how sustainable the current levels are?
Well, for stock-listed companies, as Evangelos also mentioned, there is great visibility on a great percentage of their trading days for the next 2 to 3 years. So they're quite insulated from any fall in the freight market that would possibly lead to also less demand for ships to time charter. Also, with the interest we're seeing for our ships that open within the next, let's say, 12 months, I feel pretty confident that profitability and these very nice cash flows will be there for the next 2-3 years for every container company. Especially for Euroseas, which is a pure container company and probably the only one left in the US markets, things look quite optimistic as far as our earnings visibility is concerned. But the key here is not only that, is what will happen to the container market when certain events happen. I mean, we all know how sensitive our market has been in the last 12 months to the Suez events and the Houthi attacks on the ships. 12 months down the road, I feel that the situation is much better because the great part of the order book has been absorbed over the last 2 years. Of course, a reversal of the situation, which is not a pleasant situation to describe, despite the fact that has brought us a lot of profits. A reversal of the situation, I think, will definitely have a negative effect, especially on the freight market, and it will continue in our markets as well. But I think that it's going to be shorter-lived than what we thought 12 months ago. I believe that any recovery will come quicker. There is a very, very big percentage of old ships that is controlled by the liner companies. And if they choose this time not to fight for a market share, but for their profitability, I think the duration of any bad market or the rebalancing of the fleet when the Suez situation is resolved is going to be much shorter than what we thought 12 months ago.
Yeah, thank you, Simos. So, Stavros, taking that forward, so given that in shipping nothing is ever certain, and Simos's concerns and Evangelos as well, that this might not be quite as far-reaching as everyone thinks, this great period. What do you see as the potential risks of delaying raising equity or capital?
Thank you, Salian. I think you will be hearing the same things from all of us in this panel. I mean, it's not a matter of delaying or being prompt in raising equity. It's whether you need to raise equity. And I don't think that anybody in this market needs to really to raise equity. All the sectors have been performing quite well over the last 2-3 years. So balance sheets are strong. Cash flow keeps being strong. I mean, we started off by deleveraging the balance sheets, then depending on the strategy with either reserving cash for the rainy days or distributing out cash to the shareholders. So basically, no one really needs to raise equity. Now, if you ask me whether we should raise now that we don't need because we are in a position of strength, or we should wait for later on, I would reply, what would we do with the cash? I mean, new building economics do not add up in the dry bulk sector. And then basically, whatever needs the company has in terms of CapEx, CapEx, either in terms of maintaining, upgrading, or renewing the fleet, I mean, we can cover through operating cash flows. So I would say that, yes, there is a risk. I mean, if the capital markets are there, there is a risk in waiting. But again, there's also a big risk in taking the money now that we are already trading at a discount. Maybe the discount is even wider after you have done the deal.
Thank you. So turning to you, Hugh, because you obviously see a lot going on in different sectors. So everybody is in agreement that this is perhaps not the time when people will be immediately thinking that they need to raise capital or equity. But from what you have seen, how is this affecting the approach of different companies to the capital markets? And I have in mind, in particular, the fact that there has been reference recently to share buyback programs. But not only that, there might be other things with which you're familiar. So please talk us through your experience of that.
Yeah, happy to. As Stavros mentioned, I mean, the market has been strong for a few years. I mean, there's bumps along the way. Certain segments outperform and others catch up. But that's really provided a lot of flexibility in balance sheet design and capital allocation. And so then it really becomes circumstantial around what are the objectives. And again, Stavros mentioned this as well, for him in particular in their business. What would they do with the capital? Now, there are different forms of capital. We've talked about equity, which is really an opportunistic instrument. That can come in different forms, right? If you have an opportunistic seller, it can be the day of. That's usually a private equity participant. If it's a corporate, there's usually long lead time. There's months or years of preparation around what the messaging is, whether the use of proceeds, building the right rapport with investors in advance through roadshows or engagement. You know, it may look like a quick deal, but it takes months or quarters or years in the making. Beyond that, if you look beyond the different capital approaches, I think, you know, there's been some reference to the debt markets. You know, there are certain securities that are working and windows that open periodically. From what we hear, commercial lenders that want to stay in the space are open for business and, you know, have put forth very competitive ideas and structures. You know, I think Evangelos mentioned a little bit around, there's a lack of distress for value hunters like private equity to come in. We do still come across private equity that are looking for opportunities to play, but looking for value, it's hard to find. You know, we're in a supply-constrained world, and so you have to make a very strong case for why looking under this particular rock is an advantage and something they need to deploy into today. I think you referenced a few other tactics or tools that you know, certain funds, or excuse me, corporates can use in terms of share buybacks, et cetera. That's all in the service of prepping those shares for any sort of corporate activity that they want, whether it be M&A through share issuance, going to the equity markets to build their market cap, build their relationships, raise money, what have you. So that's broader toolkit, really.
This could be a very dull panel if everyone's got exactly the same view. So let's see if we can find any differences. So I'm interested in finding out whether there are different views as to whether the better option for shipping companies, if they were to want to go down this route, would be private or public equity or debt. Perhaps Simos, my understanding is that at Euroseas, you've been doing a combination of public and private equity deals. Assuming that's right, and tell me if it's not, could you talk us through why you've been going down that route and what your thought processes were?
Well, depending on the timing and certain circumstances, we are open to explore both ways of raising capital. Conceptually, I mean, we're public companies. Public equity is what we're looking for. But to do a successful deal and raising public equity, we have to use your share price, your stock as a currency. At the moment, there isn't a shipping company that, at least in the container sector, that would sacrifice value of the existing shareholders to raise public equity. It's not the environment to do it. So at the current environment, I think doing a joint venture with some private money and using some of our own funds, which is more than enough at the moment, it's easier to structure. Otherwise, to raise public funds at the moment, we would have to sacrifice our existing shareholders' value, which is something that, in general, we don't like doing. I mean, it has to be an exceptional project in front of us so that we would sacrifice some value from our existing shareholders to go ahead and proceed with a big public fundraising. At the moment, I don't think that public issuances are a way to grow. It's very difficult, I mean, to do that. Existing shareholders will have to lose value. We have to sacrifice their equity to raise such capital. But I think there are also other ways, as you mentioned. You can do a joint venture with somebody that shares the same views with you on the market, and this is a way to grow the company as well. I mean, public money, it's obviously a simpler capital structure. I think it's better for the investor to see a cleaner, a simpler capital structure in a company, but it's not the only way to grow. So we have to adapt to what the market brings us. in that sense.
Yeah, thank you. So Stavros, I think at Seanergy, perhaps in contrast, you've gone down the route of a number of perhaps smaller public equity deals. Again, if that's right, and tell me if I'm wrong, let me know what your thought process was of that, especially when you compare it perhaps to Simos' views about how it should be done.
Of course. First of all, I mean, we haven't done any equity offering in Synergy since February 2021. The last one that we did back in February 2021, it was priced at 2 times our NAV, and we used it to buy assets that were at a discount, actually. I mean, the upcycle was just starting at that point. So basically, raising equity at a premium to NAV to buy assets at a discount to their future earnings capacity is a completely different story to the current play field. Now, I mean, you're faced with the decision to raise equity at a discount to your NAV to buy assets that are trading at a premium, which doesn't make any sense. So indeed, we have used the capital markets in the past, and actually the capital markets have been the growth engine of the company, but under very different circumstances than the ones that we are today. And I do think that public equity, I mean, it has a role to play in the industry, especially if you think the capital that the industry is going to need to ensure the green transition and non-carbon ships and what have you with the new environmental regulations. There is a role to play, and public equity is inclusive, is scalable. You have, of course, to bear the... I mean, investors have sometimes smaller time horizons and different agendas. So basically, the share price might go through shocks because of that, whereas private equity is a bit more flexible and has longer horizons. So bearing in mind the capital that the industry is going to need, I think that both public and private equity have a role to play, and they should be working hand in hand in the future.
Okay, thank you. So this might be a tough question for Hugh, and feel free to sit on the fence to a certain extent. But from the perspective of your position working at a financial institution, given the current environment and what everyone's been talking about, what are you advising shipping companies? Are you saying go down the public equity offering or the private equity offering, or is there some other form of financing that you're seeing being more popular at the moment?
So generally, I think our clients come to us with a good idea of what they want to achieve, right? They have a certain objective, and at the end of the day, they come to us seeking advice on what's the best path to achieving that objective. And we can provide our color on exactly what we hear, what's the feedback, if it is around investors, what are investors looking for, what are some of the pitfalls, et cetera. When it comes to those objectives, we've seen, largely as referenced in the previous panel, there's been a lot of M&A, which has been facilitating exits or accommodating consolidation. When clients come to us with ideas around accessing markets for growth, I think and sorry to hedge here, but it is, again, dependent upon the circumstances. Is it a project of sufficient size and deliverability on cash flows that it is appropriate for the public markets? If so, which venue? We do deals in the US, we do deals in Europe, we do deals in emerging markets, and there's a forum and a format for each one of those transactions that may or may not apply. If it's not appropriate, there are a number of investors that have made a lot of money in the space, partnering with a lot of people in this room, eager to see new deal flow. Sometimes, we're sought to help with that, but generally, I think it comes down to what are the objectives. When it comes to financing, I think that businesses, everybody on the panel here knows their business, knows what the commercial banks are willing to kind of put together, and so it becomes a solution as to how you fill out the rest of the cap stack if you have growth considerations. To kind of put it in a finer point on it, we have to listen to them first before we can really tailor what our recommendation would be.
But if I may say so, I mean, given the disconnect between equity valuations and fair value, where it makes it very challenging, of course, to raise equity. And speaking of public capital, I believe public debt is a very appealing option. I mean, we have actively pursued that path we took a brave decision, given the volatility in shipping. I believe it's a brave decision to decide to get a credit rating. We went through it. We now have an S&P and a Moody's rating. Actually, yesterday we got upgraded by Moody's. We have a BB plus rating, which is the highest rating any shipping company has ever had. We've accessed the debt capital markets. We've issued a bond back in the beginning of 21. It's important to, as with equity capital markets, to enter the market, become an issuer, become known. You start having credit analysts following you. You start building a track record with you being with the rating agencies and all the universe of the debt investors. And actually, you can get to a point where you can access decently priced capital. It also, of course, depends on the broader yield curve developments. It was much better when long-term rates were at 2% rather than being at 4 or 5%. But having said that, you have access to a huge pool of capital, the international bond market. There's always money available at a price. You get very flexible terms. You do bonds that are non-amortizing for 5 or 7 years with no maintenance covenants and what have you. So you sort of have the freedom to manage your balance sheet and allocate your capital as you see fit. It comes, as I said, with the bells and whistles of getting a credit rating and all these things, but it's a much more plausible sort of public capital solution than equity is, at least for us right now.
Yeah, no, that...
If I may add, as the interest rate environment is on a declining trend, this kind of instrument that Evangelos described could possibly be more appealing in going forward. And you could be more creative with such instruments if interest rates fall to much lower levels than today, and investors are looking for other opportunities to invest. Shipping could be a very good choice for them. But let's see how this evolves, this market.
Yeah, those are the
And Norway is also a good alternative on that when you're considering bonds. Maybe you cannot get, after the rating process that Danaos went through, and you can get much more competitively priced. But I saw MPC's unsecured paper that got priced at 7.4%, which is pretty decent for unsecured paper, and that was like a couple of weeks ago. So Norway can also be a good alternative.
Of course, Norway is an obvious alternative, but there you're restricted in terms of size. You cannot do big tickets. And also with Norway, up to a certain point, if you want to refinance the bond and you're in a bad phase of the market, you may be a lot more challenged than what you would be if you were issuing in the international bond markets that are much more liquid. And as I said, at a price, there's always capital. In Norway, this is not always the case.
No, that's interesting. I think, that's what people do in their private lives, isn't it? So if you have your credit card and you pay it back regularly, then you improve your credit rating. It sounds as though you're applying that on a much bigger scale and doing well with it. Okay, so I'm bringing it back to basics. So Evangelos, on a slightly different level. So for me, when you invest in companies, one of the issues always is to think about getting a return on your investment. So everyone is cash rich, as we're saying at the moment. So how do you decide whether you're going to reinvest your earnings or return some capital to shareholders? How do you make those sorts of decisions?
Well, it could take me half an hour to answer this.
Briefly.
It's not that simple of an answer, but briefly, listen, there is, as you said before, in such an environment where our earnings are very strong, our cash balance is building up week by week, and our valuation is suffering, one of the obvious things to do would be to buy back your stock, right? I could not think of any better project to enter into, to be honest with you, than acquiring our own stock at such a discount. Of course, after a certain point, it becomes counterintuitive because you then hurt liquidity, and then why are you public, right? So we are reviewing projects on a case-by-case basis. It's not easy to find good projects these days. It's not easy to deploy capital, exactly because there's no distress in the system. Everything is expensive. Even M&A opportunities, or what, even if you have willing sellers, as Doug mentioned, they have unreasonably high expectations. And if you're mindful of managing residual risk, and in shipping this is of paramount importance, I don't think many people would go out on a limb and pay 10 or 12 times EBITDA to buy shipping assets. So it is a challenge. We try to keep a balanced policy. We do pay a dividend to our shareholders, but we also try to keep dry powder because at some point, and it's happened in shipping for the past 100 years, the downturn will come and opportunities will present themselves. And at that point, only people who have the dry powder to take advantage of these opportunities will be able, I mean, this is how in shipping you create outsized returns. You invest in the bottom, and this is plain and simple, and that's what you should work towards.
Yeah, thank you. Does anyone else have comments? Yeah.
Well, what we have noticed over the years is that the most important factor of pricing a stock-listed company so that it makes sense to be a public company is size. So, despite the fact that there are many times debates even within companies of what to do with the profits that somebody has made, I think for a listed company, it has to reach a certain size before starting distributing money to its shareholders, because otherwise it beats the purpose of being public. Now, most container companies have reached levels where they can comfortably say that with the 2-3 years visibility they have, they can maintain a decent dividend. But as I said, I think that first you have to reach a certain size before you start thinking distributed money. Now, for us, the choice was obvious. I mean, we started 5 years ago. We were a 20-30 million company. Now, our value is more than $500 million for Euroseas. The market cap is slightly less, but you know the company is worth this range. Obviously, the decision was very correct. It was a correct decision not to distribute our money because our investments have yielded much better than that. But as I said, the most important factor before deciding to distribute money is to reach a certain size. Otherwise, in my view, it beats the purpose of being public.
Yes, thank you. So, Stavros, for you, if you were being asked about going public or staying as a private company, what would your advice be? Do you see this as a time when more people are going to be thinking about going public?
Look, I mean, if you want to gain scale, then you have to go public. I mean, you cannot go public by being private unless if you're supported by a super wealthy sponsor who would have gained scale already. So for me, I mean, if it's a matter of scale, then you should go public. And at the end of the day, I mean, we are operating in a capital-intensive industry. So basically, you need capital, and the public capital is one way to go about it. At the same time, we own depreciating assets, and in order to continue to be relevant, you need to renew the fleet, you need to invest on the ships. So public equity is a way forward.
Yes, thank you. And you did talk a little bit earlier. Okay, you did talk a little bit earlier on about what to do with your money. Perhaps one of the obvious answers to that would be to think about all of the issues, the environmental issues that are facing us, already facing you, and facing the future. So, from a lawyer's perspective, there is a lot of regulatory stuff coming your way that's already here. So investment in dual-fueled vessels and all of those sorts of issues. I mean, there is plenty of opportunity potentially to invest your capital. I mean, it's a bit different from capital markets, but I mean, in terms of, there are things to put your money into. Does anyone have a view on that? Or not?
I'm not sure I understood the question. You mean if it makes sense to invest in everything related to environmental...
Or some, yes. I think because, I think it was Stavros that said, at the moment, sort of, people just don't know really what to do with their money.
Well, if you think historically, in the last 10 years, every dollar that has been invested in anything related to improving the environmental footprint of a ship has yielded very well, from scrubbers to eco ships to everything. I think it's a good investment for ship owners. So I would think that going forward, this will be the case again.
So we'll basically continue. Stavros, do you agree?
Yeah, we're doing basically the same thing. I mean, it's a matter of corporate strategy. For us, we have a dividend policy whereby we distribute 50% of our operating cash flow, and the remaining we invest in our ships and make them more efficient, installing energy-saving devices, renewing the fleet, and what have you. So, but my point before was that you don't need to raise external equity right now to do that. The operating cash flows are sufficient to cover both aspects of the strategy.
Okay, so it's not that you're not doing that already, it's just that you don't need more money to do it because you've already done enough. Okay, lovely, thank you. Okay, so I think we don't have very long. So should we stop now? Or have I got time for one quick question?
30 seconds.
Okay, 30 seconds each. So what do you see, each of you, in a sentence, as the key risks going forward in terms of what we've been talking about raising capital and equity and the potential downturn? Some of you seem, in fact, probably all of you seem to have put yourself in a good position. You've certainly improved your credit rating, etc. But what are the key risks that we're all facing?
Geopolitics.
Okay.
That is something that you never know what's going. 3 months or 6 months or a year in today's time is a very long time. It's the events, the black swan events you cannot predict. And of course, they may affect our industry positively, as they have, most of them until now, but it could also be the opposite side. This is, the big uncertainty is what happens in all those fronts, geopolitically and politically, in the Middle East, in China, with Russia, with all these things.
Yeah, okay, thank you.
I would certainly agree on the importance of the geopolitics at the moment, not only in the container shipping, but in more sectors. But I think the most important thing is a growing demand trend. If we are in an industry that demand trends are growing, there will be moments that the circumstances which will be very, very favorable to make good profits. So I think the biggest risk going forward is the possibility of globalization diminishing. There's, countries starting producing locally because of either geopolitical tensions or even for economical reasons. I think this is the biggest challenge for shipping.
Thank you. Stavros, do you have?
Well, I think what Evangelos said before, geopolitics and black swans are the major risk. But for once, let's close it on a positive note. Let's hope for big flamingos instead of black swans.
Thank you.
Those are all good answers. I think just reflecting on my career in the industry, I think, one of the things that we always struggle with is supply. And, we've had events conspire to improve the supply dynamics. We have shrinkage in capacity and material costs, et cetera. So all of that has put us in a good spot, but managing that going forward is obviously something everybody in this room has an eye on.
Okay, thank you all very much.
I just want to add one point. Despite the risk I mentioned, I don't feel that there is great probability of that. The Western countries are struggling to find hands to serve certain needs of our societies. It would be very, very hard to bring back production on levels that would materially affect shipping. But the risk is there. We're hearing the politicians, how they threaten each other and all that stuff. But I think in reality, the risk is less than what we fear.
Good, lovely. So we have our pink flamingo by the sound of it. All right, thank you very much, panelists. Thank you.
Okay, thank you, Salia.